And I don't need these glasses. They're blue light blocking glasses, not vision glasses. Tricked you. Anyways, sharing an update on my $10,000 to $1 million portfolio. It's a real money portfolio, and I'm trying to grow it from $10,000 to $1 million over the next 10 years. Super boring, not trying to get rich overnight, trying to build a portfolio using a long-term investing strategy that nobody seems to like to talk about these days, but that's how I think I want to build my wealth and how I think real people with real jobs can also build their wealth. I'm just a person on YouTube, not a financial advisor. This is not financial advice. Right now, portfolio value is $17,000.52. We're up $1,000, which is about an 8.35% return. I've got the portfolio broken into 3 different buckets. We've got our growth monsters, currently about $14,000, and that's up 14%. So that bucket is the biggest gainers. We can over here, we can see the actual percentage of the portfolio, the total portfolio that is, and then my target size. I'm not worried about getting them exactly to the target right now because we've got so much money coming in through regular contributions every month that we'll get to those targets over time. I think there's a lot of opportunity in growth companies right now because of the sell-off and because of their future growth potential and the quality of their businesses. That's where I'm weighting most of my money right now with new contributions. As a note, we add $1,500 to this portfolio every 2 weeks. And over time, we're going to try to actually add more than that. The dividend growth bucket is about 15% of the portfolio, and the target is 20%. And then we've got crypto here, which is a new bucket, which I'll talk about in a little bit. And so let's jump into the holdings. And so these are just from top to bottom. We've got 27 positions, $15,785 cost basis, and about a $17,000 value there. And so GitLab is the largest company in the portfolio. It's up 39%, which is a pretty great return over a short period of time. Cost basis is about $1,100, and it's currently worth about $1,500. Monday, cost basis is about $1,000, up 22%. Current value about $1,300. Twilio, cost basis about $1,000, up 21%. Again, current value $1,300. DigitalOcean, same thing, $1,000 cost basis, up about 20%, and currently worth about $1,250. Snowflake, $900, which I'm adding to today. I wrote about that in my email newsletter, austin.substack.com, if you want to check that out and see why I'm adding to Snowflake in more detail than just somebody on YouTube talking about a position. The newsletter allows me to go into detail about what I like about them and share different things. Currently about a $970 position. Not going to go through all the rest, but we've got ServiceNow, Upstart, The Trade Desk, Shopify, Mercado Libre, also adding to this one. Hit the newsletter if you want to find out why, austin.substack.com. Coinbase, HubSpot, Datadog, Amazon, Salesforce, Adobe, Zoom, MasterCard, Broadcom, AbbVie, American Tower, Fidelity, Amgen, 3M, and Advanced Auto Parts. Another one I'm adding to today, Raytheon Technologies, and Lowe's. Next, let's jump into, it's currently before the market opens, so not sure exactly when this will come out. The market will probably be open by the time it comes out, but here's how things are looking. Looks like the biggest change pre-market is Fidelity. Then we've got Monday that's also up, Shopify, Upstart, 3M. Looks like everything's up so far. Looks like it's probably going to be a good day. I have no idea what's going to happen today. It doesn't matter on a day-to-day basis what happens. What we're doing here is we're building long-term wealth. I'm not going to sell anything today based on what I think the market's going to do, or it swings in the middle of the day. That's popular out there today. There's a lot of people talking about the hot stock you got to buy now. I'm looking for companies that I want to own for years and sharing the journey of building this portfolio over time to hopefully give some perspective on what long-term investing could look like for people that have real jobs and can't sit and stare at the market all day. I'm obviously pretty oriented towards growth, but I do have the dividend bucket of companies. This is Simply Safe Dividends, not an advertisement. I'm a paying user of theirs. What I've done here is I have made the dividend side of the portfolio, I've simulated as if it were basically the whole portfolio. So we can see the $17,600 balance. If my dividend positions were that size, if they were the total portfolio, this is what it would look like. I do this because part of me just wants to pile all my money into these dividend stocks, even though they're not as exciting, and you may not get the 10x or 100x upside to some stock that I think I might get in the growth bucket, but they're a heck of a lot safer and a lot less stressful. And so I'm going to run this over time, this simulation. I'm going to share it out and kind of see what it would look like compared to, my actual portfolio. So anyways, right now with a $17,600 portfolio, I would be getting $474 in annual income. Pretty awesome. Don't really need it right now because I'm not retired, but watch how this grows over time. The current dividend yield of that bucket would be about 2.7%, which is not bad, with a beta of 0.85. And that just means that it's less volatile than the overall market. So if the S&P 500 moved like 10%, then it would be expected that these would move about 8.5% based on that beta. So a little bit less stressful potentially is the way we could look at that beta number. If it's below 1, the stress level is lower. That's how we can look at it. Dividend safety. So this is a really cool feature of Simply Safe Dividends. They identify it based on all the metrics that they look at, which I'll talk about in another video. Let me know in the comments if you want to see a video on all of their safety metrics. 13% are borderline and 87% are likely safe. We can go into that a little bit in this video. Dividend growth over the last 5 years. This is huge for dividend growth stocks. Diversification. This is a pretty diversified bucket. We've got 23% in healthcare, which is generally pretty recession resistant. 23% in information technology, 20% in industrials, 13% in consumer discretionary, 11% in real estate, and 10% in financials. The top income sources, they suggest that no individual stock, funds excluded, contribute more than roughly 5% to your total income. So I'm kind of breaking that rule here, but that's all right. 3M is making up 15% of the total dividend income, and 3M is not a dividend growth stock, really. They're not growing the dividend very fast and not really expected to, but this is kind of an outlier, and I own it because they have a high dividend, about 4% right now, and the stock is pretty undervalued compared to where it's traded at historically. So I made a little exception and owned 3M because of the quality of company and how high the dividend is, and it's a little bit looking undervalued. Amgen, 14.75%, AbbVie, 14%, Fidelity National, 13%, Advanced, 12%, Broadcom, 10%, American Tower, 9%. And we'll jump into the dividend growth real quick. So this year, these companies grew about 15%. If I can average between 10 and 15% dividend growth, that would be amazing. Last 5 years, 13%, and last 10 years, 14%. So right up there at those averages. And so that would have turned $108 of dividend income in 2012 into $469 in 2022, which is pretty awesome. All right, the income forecast. This is one of the biggest things that makes me lean towards just doing everything into these dividend stocks, which maybe when the growth stocks get expensive again, I'll allocate that way, but I think we've got some room there. So this is based on a 10% per year dividend growth, which the portfolio's current dividend growth rate is 13.1, but they use 10% to be a little bit more conservative, but they give you a little chart here with different income scenarios. So right here is the 3% boost from dividend reinvestment. This would be if I was reinvesting dividends, which is what I would do if my whole portfolio was the dividend income, because I don't need to live off of those dividends right now. But that's based on the portfolio's yield. We'll assume reinvesting adds 3% to your growth rate for total annual dividend growth of 13%. So we would actually be looking at the 13% number. And then if we went more aggressive, then we'd be looking at that 16% number, because that would be the actual 5-year dividend growth rate plus the 3%. So 13 plus 3% would be 16. So we'll look at both of those numbers. And this would be contributing $48,000 per year, which I've talked about this in a different video. Right now I'm doing about $3,000 a month, which is about $36,000 a year. But my goal is to average higher than that, which is a lot of money. And if you're investing and you're not there yet, don't be discouraged, because we all start somewhere. And the most important thing about investing is time in the market. The earlier you can start in life, the better. Anyways, this is a big, challenging goal for me, which is why I have it here. I'm probably not going to make that, but it'd be awesome if I did. All right, so this chart is looking at the 13% annual growth. So right now we're making $474 per year, but by 2027, so 5 years from now, we'd be making $9,000 a year. By 2032, 10 years from now, $25,000 a year. So in 10 years, I could be making $25,000 of dividend income. And if you think about the average income in the United States, that's a very nice supplement to income, or if you don't need it, to be able to add back into your investments. $55,000 a year in 2037. So notice how in just 5 years between 2032 and 2037, the income basically doubles. And then from 2037 to 2042, it doubles again. And by 2042, 20 years from now, I'm earning a very livable income from dividends, and I could retire and just make YouTube videos all the time. Is YouTube even going to be around in 20 years? I don't know. We'll see. Anyways, that's an awesome, awesome tool. And let's just run through these real quick, and I'm going to rate them again. This is why I love Simply Safe Dividends. You can rate them by dividend safety. MasterCard, they call very safe. Lowe's, very safe at 93. Advance, 89. American Tower, 78. 3M, 75. Amgen, 74. Raytheon, 70. AbbVie, 70. Broadcom, 67. Fidelity National, 58. All right, let's jump over to Fast Graphs and just get a look at, based off yesterday, we'll get a look at kind of where the valuations of these high growth and tech and software as a service type companies that I own are. What we're looking for, just as a quick gauge, is that this black line right here is the current price, is below the orange line, which represents the fair value of the stock according to Fast Graphs calculations. So not going to go into that. I've talked to that in future videos or in previous videos, and I can do a whole tutorial on Fast Graphs if you're interested. Let me know in the comments, and I will. Anyways, I own Adobe. It's a small position. I'm not looking to add to it because it's still pretty premium valued, and I think there's other opportunities. Amazon is in the growth bucket, but we got to use operating cash flow, not sales. And Amazon looks extremely undervalued based on expected growth of operating cash flow. And so I do like Amazon, and it's a pretty decent sized position for me. Coinbase, it's a tough one to use this on because who knows what's going to happen in crypto. And more specifically in their line of business, which is they get a lot of fees from transactions, and people are wondering if those fees are going to go down with other people that are offering different, crypto services and exchanges. So we'll see there. Now that I have exposure to the crypto bucket, which is just through two ETFs, GBTC and ETHE, which is the Grayscale Bitcoin Trust and Grayscale Ethereum Trust. I think it's Ethereum Trust. I'm not concerned with really adding to Coinbase because if crypto does well, Coinbase will probably do well, but those ETFs should also do well. Salesforce is looking pretty decent. It's a decent sized position, and it's one that I could certainly add to in the future. Datadog, they've got a very high price sales ratio with very high expected revenue growth. Up to 40% revenue growth per share in 2024. It looks like we could get a good return here, but just because it's priced for excellence, I'm going to keep the position I have. I'm not looking at increasing it. DigitalOcean is actually pretty pretty fairly or undervalued based on expectations. So that's one that is on my list at the top of my watch list for potential purposes. HubSpot, as we can see, great company, solid performance over time, but not at a discount right now compared to other stuff. Mercado Libre, just clearly right there, we see a lot of opportunity based on historical numbers and what they evaluate fair value as. Again, talked about Mercado Libre in the email newsletter, austin.substack.com. Check that out if you're interested. If not, totally understand. Monday's in a very competitive space, expected to grow extremely fast, and they're if they hit those numbers, they're trading at a very reasonable price to sales ratio. So it's a big position for me now, and one that as I keep my confidence in the company, specifically their ability to grow from kind of like bottom up in a company to enterprise or larger style sales and beat the competition, I might look to add to Monday. ServiceNow, kind of same as I put this in the boat as like Adobe, HubSpot, a little bit, premium valued, but expected to grow ahead. And so we'll look to add to this when I want very high quality growth. I've got it in the portfolio, but just not adding right now. Shopify looks cheap compared to kind of historical norms, but it's been a crazy period, which has pushed this normalized PE ratio up. So want to see kind of how things shake out over the next couple quarters, and then would potentially look to add to Shopify. But again, I'm adding to Mercado Libre, which is in the e-commerce space, and I've already got a position in Shopify and Amazon, which gets the US e-commerce exposure. Snowflake, very, very premium valuation, but one of the fastest and most predictable growers in the public market, especially at its size. And so talked about a few reasons I'm adding to that one in the email newsletter. The Trade Desk, again, same boat as HubSpot, ServiceNow, very high quality, little bit, overpriced compared to normal valuation, but could very well grow into that. Gonna hold off on buying for now. Twilio looks undervalued. Question on them is just, can they get to profitability? And so want to see some progress towards that before I make my position larger. Upstart, pretty large position for me now. Some questions around what type of lending and borrowing environment we're going to be in the United States. Not that they don't make loans themselves, so they're not at risk there, but they facilitate them. And if the demand for loans go down, then that could hurt Upstart's business over the short term. I think long term, very solid company, but I'll look to, it is towards the top of my watch list to potentially add to in the coming months. But we'll just see what happens kind of over the next few months as I get new contributions. Not going to sell, but kind of just hanging on before I add. Zoom, I have this belief that they're just going to blow numbers out of the water for the next 3 to 5 years, but I'm not confident enough in that belief to add a lot to my position. But it's a very high quality company, profitable, strong free cash flow in a huge market. They're just coming off such challenging numbers, and the stock has been crushed. So I own a position. It's actually one that I'm gonna give more serious consideration to for adding to. I need to do a little bit of research. Last thing is just jump into some of the news. This is Seeking Alpha. I've got the portfolio here, and let's just look at some of the news for some of the companies in the portfolio. I'm not going to go super in depth here, but this is how I catch up on my stocks in this portfolio. And once a week would be enough for this stuff if you're investing long term in high quality companies and not looking to make daily transactions. And so that's all I'm trying to show with this portfolio is a example of how I think somebody that's going to build a portfolio over time, a process that they could potentially use for doing that. I'm not saying to buy all of the companies I own. That would be the worst possible thing. You have to do your own research and study these companies and have a thesis on them. I'm just trying to show by example a way that we can build these portfolios and hopefully build wealth over time. And the cool thing is you'll see if I do or not, because I'm going to share the value of the portfolio. So hope you stick around and like these videos, subscribe if it's valuable. Anyways, let's jump into the news. Let's see. Prime Block, an infrastructure provider for blockchain technology that mines cryptocurrencies, and 10x Capital Venture Acquisition Corp announced planned merger. Interesting. Doesn't really have that much to do with Coinbase. Broadcom announces private exchange offers of certain outstanding notes for new notes. Broadcom announces, okay. Raytheon Missile and Defense awarded $651 million to produce Spy-6 radars for next-gen U.S. Navy. So when we looked earlier and we saw, so the market's actually open right now. Let's see. Okay, looks like growth is having a good day. All right, we'll take it. Again, not making any changes, but hey, not bad when stocks are up. Actually, it is kind of bad because then you can't buy more cheaper. And if I'm buying for the next 10 years, which is what this portfolio is designed to do, I actually want stocks to just be completely flat or down for the next 9 years and then just rocket in the last year, because I will have been able to buy more shares than I can if prices keep going up. But as a human being, you want to see prices go up. It's like this crazy phenomenon, you know? All right, anyways, Raytheon's not really reacting crazy to that news. So it looks like that news was kind of built into expectations already. These things are long. They're long processes. And so this was most likely expected. Superwise model observability platform joins the Datadog marketplace. That's awesome. That's one of the things about Datadog is they've just got all of these network effects that they're attracting, more platforms and technologies to their marketplace that customers can interact with and use for different purposes, which makes Datadog's platform more valuable. And then that's why Datadog stock has such a premium valuation. Yep, we talked about that one already. That's the Broadcom thing. I don't own Apple. Not sure why I'm getting stuff about Apple. Datadog partners with Microsoft for the Azure Cloud Adoption Framework. That's more good news for Datadog. ServiceNow secures U.S. Department of Defense Impact Level 5 provision authorization. That was Wednesday, actually. And government contracts like that can lead to, very large sustained revenue opportunities over time, but they take time. So it's always great news when you're getting authorization for more government business. Some news on Upstart. Red Rock Credit Union, they selected Upstart for personal lending. That's great. It's a small credit union. More meaning, better flexibility have become the new work perks for Canadians, says new survey from ServiceNow. Lowe's has a retail roundup that they're going to participate in. That's just an investor conference. Snowflake extends relationship with AWS to improve demand forecasting and delivery for the consumer packaged good industry. That's good news for Snowflake. They're expanding into new potential software offerings or platform offerings for the consumer packaged goods industry. It's always great when you're growing industries. Blue Yonder and Snowflake partner to unlock the value of data in supply chain management. HubSpot partners with Pipe to help startups unlock up to $100 million in free funding. Zoom announces the next evolution of global partner program. Zoom's partner program is a big part of their future business and how they can sell into larger organizations. And so anytime they're expanding that program is good news for the future of Zoom. It's not groundbreaking, earth-shattering news today. All right, and as the treat at the end of the video for sticking around, we can see I've got 5 buys that are in the morning progress trade window this is how M1 works. I just set these as buys and then they have these trade windows and it takes care of the purchases for me. So I'm going to show you exactly what those buys are. Snowflake, Mercado Libre, Grayscale Bitcoin Trust, Advanced Auto Parts, Ethereum, buying 500 of Snowflake, 500 of Mercado Libre, 750 of Grayscale Bitcoin Trust, 500 of Advanced Auto, 750 of Ethereum. There you have it. Hope you have an amazing day. Take care of your mind, your body, and your money. And make sure you come back and follow this journey of building this portfolio from $10,000 to $1 million and build something of your own.